Right now, shares of Datavault AI, ticker DVLT, are exploding. The stock is trading live at $1.73 per share, which is up a staggering 33 cents or 24.22% on the session. We are seeing absolutely massive volume, with nearly 38 million shares already changing hands, smashing its daily average. And when a retail investor, perhaps scrolling through their Robinhood app or their SoFi Invest account, sees a sub-$2 stock with AI in the name rip higher by over 20%, the expectation is immediate. They think they've found the next NVIDIA stock before the breakout, a ground floor investment in the next big thing. The expectation is that this is a technology story, that Datavault AI has just announced some incredible new platform or a massive contract. But the reality, what is actually happening today, is something so much stranger, so much more complex, and so much more dangerous that it completely reframes what this company is. The reality is that this isn't a simple tech story. It's a corporate action, short seller-focused, high-stakes poker game, and it's all happening at once. Let's get this straight. The primary catalyst for today's 24% surge appears to have very little to do with a new AI product. Just yesterday, Datavault AI's board of directors approved the distribution of Dream Bold Draft meme coins. You heard me correctly. The company is issuing a special dividend, not of cash, but of a meme coin related to the Dream Bowl 2026 to all its shareholders of record as of November 25th. This isn't just a quirky marketing stunt, it's an explicit and aggressive move against short sellers. In their own press release, the company clearly states that short sellers who have not covered their positions will become naked short on dividend meme coins and will be obligated to deliver these dividend meme coins to the shareholders they borrowed from. This is a direct, calculated attempt to engineer a short squeeze, to create a situation where an undeliverable asset, a unique meme coin, creates a massive liability for anyone betting against the stock. This is the kind of high-risk maneuver that has absolutely nothing to do with traditional online investing and everything to do with modern market mechanics. This is a narrative war. If that wasn't enough, just one day ago, the company also announced it had filed a lawsuit against the prominent short-selling firm Wolfpack Research, accusing them of releasing a false and defamatory report. So in the span of 48 hours, Datavault AI has declared all-out war on shorts, first through the courts and second through this highly unusual meme coin dividend. This is the reality of the 24% pop. It's not people on their Fidelity mobile app buying because of a great earnings report. It's a swarm of speculative traders, perhaps using Robinhood stock trading or the SoFi active investing platform, piling in, betting that this short squeeze by dividend design will actually work. They are betting that the shorts will be forced to buy back millions of shares, sending the price flying. The expectation is AI, but the reality is a corporate action play designed to punish bears, and it's pulling in anyone looking for that high volatility action, a volatility that makes Tesla stock look calm by comparison. Now, does this mean the company is just a meme? This is where it gets even more complicated. The company does have a stated business, or rather two of them. On one hand, Datavault AI presents itself as a leader in AI-driven data experiences, valuation and monetization of assets in the Web 3.0 environment. This is the data science division. They talk about tokenizing real-world assets, or RWAs, claiming just yesterday that they are in dozens of contract negotiations to tokenize potentially trillions in assets. They even have a partnership with IBM to build a data vault bank. This is the grand futuristic narrative. This is the story that gets them analyst price targets of $3, or in one bullish report, as high as $7. It's the story of turning data into tradable assets. But then there's the other side of the company, the acoustic science division, which features legacy patented technologies for wireless high-definition sound. This strange combination of futuristic Web 3.0 AI and older audio tech suggests a complex corporate history, likely the result of a reverse merger, which is common for companies of this size. So, you have this incredibly ambitious, almost fantastical narrative about tokenizing the world's assets, and then you have the reality of the balance sheet. And this right here is what every single person considering an invest online position must understand. This is the information that separates a self-investing person from a gambler. You won't find this on the front page of the Robinhood app. You have to go into the filings, the kind of deep research you'd do on Interactive Brokers or a Fidelity trading platform. Let's look at the numbers from their last quarterly report. The company did report revenue of $1.74 million, which was a nice 400% increase, but that was largely due to an acquisition. The problem is that to get that $1.74 million in revenue, they had an operating expense of $12.49 million. This led to a quarterly net loss of over $37 million. Their trailing 12-month net loss is over $68 million. And here is the most critical part. As of that last report, Datavault AI had only $662,000 in cash on its balance sheet. That is not a typo. $662,000. At the same time, it is carrying over $38 million in total debt. Its current assets do not cover its short-term liabilities. This is a company that is burning through cash at an alarming rate with a net profit margin of negative 1,545%. So, how does a company that loses $37 million in a quarter with less than $1 million in the bank survive? By selling its own stock, massively. In the last year, the number of outstanding shares has increased by nearly 3,000%. Shareholders have been substantially, devastatingly diluted. This is the machine. The company survives by printing and selling new shares, and to sell those shares, it must maintain a high-flying narrative. Today, that narrative is a war on shorts, a meme coin dividend, and the promise of tokenizing trillions. This is the ultimate tension between expectation and reality. The expectation, fueled by the 24% pop, is a rocket ship. The reality is a company in a financially precarious position, burning through cash, that has just launched an all-out war against short sellers using a meme coin dividend as its primary weapon. It's a company that also, by the way, has a side business in live joke copywriting at a comedy club. The future here is completely binary. Either this squeeze and dilute strategy works, and they raise the capital they need to become a real company, or the narrative fails and the financials, which are currently dire, will be all that's left. The risk couldn't be higher, but for 38 million shares traded today, that's exactly the appeal. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.